Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for showing up every week. I have a great show for you today. My guest is Brian Ferguson of Altunas Capital, and our main topic is the value of operational intelligence in large-scale multifamily. But we go through Brian's whole journey and how he didn't take somebody else's money for 16 years. You're going to hear about it right at the start of the episode. Now he's doing syndications at Altunas, but we really talk about the nuts and bolts of what you can learn by vetting a syndicator. Stay tuned for Brian Ferguson. This is episode 174 of Zen and the Art of Real Estate Investing with my guest, Brian Ferguson. Brian is the founder of Altunas Capital. He was at real estate investing for 16 years before ever raising a dollar of outside capital. We're going to go through his whole journey. Brian, welcome to the show.
Hey, man. Thanks for having me. I appreciate it.
Yeah. Interesting to hear about your background. And I think I want to start there because that's kind of a point of your founder statement that for 16 years you were at it before you asked someone for money. Why did you wait so long? And what did you learn from that journey?
That's a mixed question. I've changed my thought process on it. When I first, got into the syndication and, kind of partnering piece of it, I felt like I had wasted 16 years going down that. I remember going to the first conference and listening to these guys' stories and the ones that get up there and go, I've never done anything but 150 unit multifamily, all the stuff that sounds great on a stage. And I'm sure a lot of it's true. But, then in recent times, I've seen a lot of these guys that are in our industry, they're struggling. The thing about it is they got, if you got in, that's all you've touched. You got in at a good time. Your background was a CPA or a chemical engineer, whatever it may have been. You lack some of that operational. So I wish I would have done it a hair sooner.
Yeah, maybe like 10 years, not 16.
Yeah, 6 something. But those first 16, we were hands on. We started out residential fix and flip. We've done a little bit of everything, but hands on. I've done every piece of it. So when times tightened up with interest rates, taxes, every single aspect has gone up on us. We're very well versed in the operational. We own the property management company, construction company. So we know how to tighten up. We know where to save. We know that the pennies matter for the big hits. And that piece of it has, I think, just been instrumental in getting us through the market that we're coming through now.
Yeah, that's a really important point. I found across all of these episodes that the best syndicators, a lot of the best syndicators are very good operationally. Like you said, you guys are vertically integrated. So you just have a much higher knowledge sector than someone who's really good at marketing, maybe knows real estate, but doesn't know what to do when you need a whole new heating system for 225 units.
Absolutely. And, the thing is, I was actually on a call with a contact yesterday, and I said, some of these guys are phenomenal at marketing and getting tons of investors to call them and raising capital. And I'm terrible at that. I'm not good at that.
That would be me. That's why I don't do it.
But what we are good at is when we get a set of books or we see those, we have monthly check-ins and then we have our monthly statements that we get from our area managers, our asset director. But when I get those and we see that maintenance and repair line is just creasing up, let's say, if you don't have that operational experience, it's bad, but do you know how to fix it? Do you have that experience? We just went through a realm where we bought way too many AC units. Well, we know we've been down this road. The problem is you probably have some newer team members in there, and maybe they're not as experienced in repairing an HVAC, so they'd rather just replace one. So, I don't want to be the ones out there checking HVAC units anymore, but knowing that from the operational standpoint has been very beneficial in current times.
Yeah, don't you think you're also way ahead of everybody else on the due diligence phase? Because that's where I really think it also plays different, because you really know your numbers and you know what has to be fixed. Whereas people who are, swinging in from out of state or something and looking at a property and have money, but don't have the know-how, can really miss a lot in due diligence and then get shocked in inspections and not be a good buyer for that seller.
No, absolutely. I remember I was talking to a group that had bought a complex, a friend of mine now, and they used the big property management company and they paid the $50 per door for the due diligence. And again, you have those moments where you think, man, we're doing this all wrong. I take a whole team out there with drones and how much
Yeah.
I'm spending more with my own people. But then I look at but then he goes on, he gets into the deal and realized, they didn't check every door. He's
Right.
hundreds of thousands of dollars over budget. So yeah, that experience goes a long way. We have a full, acquisitions and due diligence team on staff. So we dive in pretty deep, and sometimes I feel like we dive in too deep, but boy, it prevents those snake bites, 3 months in.
I mean, it also shows that you're a true buyer to the real sellers out there and to the real commercial listing agents or even off market acquisition. Those people who own 200 units know what they're looking for. And it's not someone who just has one guy poking around 200 units. They want the drone. They want you to know everything so that when you make your offer, you're not going to adjust it because you've kicked the tires on everything.
Absolutely. I mean, it still happens. Don't get me wrong. There's still be some retrading just because things pop up. And most of the time, that's things that they didn't tell us about. They failed to tell us that, oh, yeah, there was a broken line under building 7, 8, and 9. I didn't think it was a big deal.
I think it's more likely for them to start to disclose it earlier than they would expect when they see you doing all the due diligence too. Like, well, they're going to find this. And if not, they're going to retrade. So it's in their best interest to not hide the ball because you're going to find it again. And if you just think in the traditional residential sense, I always think if I do really good on due diligence, then they need to disclose what I find also to a future buyer. And that's kind of leverage when you've uncovered stuff. Well, hey, we know nobody else knows now. So let's push the price down and get the deal done. Have you found that that's a big advantage with all the due diligence? Having that many people there, you're just not going to miss as much. But for, like you said, omissions.
Yeah, I mean, absolutely. I even tie it back into, coming from I have a finance and a sales background, but they used to, I remember an old sales manager used to talk a long time ago, the more time you spend on your feet, the less time you'll spend in the seat, so when you're out there, whether you're, selling someone a TV, a couch, a car, a house, it doesn't matter, building that rapport, you build rapport with the client, you find out what their true needs and wants are, the more time you spend there. The same thing goes there. The more time we spend in due diligence, the faster we can get it to closing. We need to know everything about it. And it's just, especially when you're, because we buy assets two different ways. I mean, we have our own kind of portfolio. We still 1031, and then we have it where we're raising funds.
Right.
But on either one of those, you have a preset budget. And, and I've gotten into one where we're over budget on the remodel, and that just makes us dig in even deeper, say, okay, we missed it this time. And, we're known for around here. I don't get upset when we miss something or we make a mistake. I get upset if we miss something or make a mistake the same way twice.
Yeah. That makes sense because, I mean, that's kind of it's the interesting thing about real estate. I still say now, every project that I go and look at, I find something new. And I've been doing this more than 30 years. Like, this is just, you're going to uncover something new every time. And it's a really good point. Okay, let's take it as a learning lesson, make sure we don't do it again, but not go crazy over something that was clearly an oversight or just a miss or something you just couldn't have known on first. But let's swing all the way back. When growing up was the first time that you kind of thought of real estate as something that might play a role in your future?
So I was, I started in the auto industry at 17, moved up pretty quick, went through sales manager, and got into the finance department. So I was in the finance sector of the auto industry, and it was more just kind of watching the original Flip This House shows and seeing some, there's some guys that worked there that had rentals. And I knew at that point that, I was good at what I was doing. I was making good money, but that wasn't the future. And then I started watching the Flip This House shows. So we bought 1, 2, 3. And then before you know it, we're doing, couple hundred transactions a year. And it just grew from there. And then we quickly realized that, okay, this is great, but we're going to have to continue doing hundreds of transactions a year forever when you're 50, 60, 70, 80 years old. So we transitioned we started getting to long-term holdings. But so I guess around that, I think I was, so we just celebrated August 30th was the company's official 17th anniversary or birthday, but we had been going about a year prior. So 18 years in.
Yeah.
So I guess I was 20 when it first really, I always had an interest in it, but that's when it really, I guess, really dove in and explored it.
Yeah. I mean, if you compare your experience with flipping all of those houses over the years, what would you tell somebody who's new who wants to flip right now? Because it's a different environment. The price cost for everything is more than it was back then. What's some advice you would give to someone who's really gung ho to flip, but has never done it?
I would say it is a great way to start because it's a way to, get some good cash flow, put some kind of dry powder in the bank before you get into the bigger deals. Because a lot of times you see the bigger deals, they're very transactional based because they need the transactional fees to survive. The house flipping has done that for us, but
yeah,
it's still a good program. You're right. It is a very much a different world. There's just so many of these. For $995, I'll teach you how to go flip houses with no money. And see, we don't operate that way. We don't wholesale. It's not what we do. We're not trying to, flip this house to another buyer. I mean, we kind of get into the hotel kind of piece of it to a certain extent where we work with end users, but we're very much a fix and flip company, but I think it's a good way to get into it. I like the old school way. Maybe that's just because I've been doing it a long time, but you buy it, you add value to the deal, by paint, floors, roof, whatever is needed. And you're really bringing some value to it versus just the wholesale route. It's like, I'm just trying to buy it cheap and sell it high.
Yeah. I think that goes to wholesale versus wholesale too, because wholesale, you have to have money to wholesale because you have to close, but that's just a lipstick flip. At least it's just like a mini practice flip. That's you just have to be able to close. I think that's a better business option for somebody who's looking to get in if they have a little money. Because a whole flip for the first time right now, I always say, I think most new flippers, it's going to cost twice as much, take twice as long, and you'll get way more red cards than you think because you just don't know what you're doing. You're not getting enough permits. You think you can DIY something because you read it on, looked at a video on YouTube, and that can set you back, right? I'm sure you've seen that over the years as you adjusted to making sure you have the process
Absolutely.
And system set up.
And I will say our processes and systems we are dialed in. Our renovation breakdown is overkill to the next level. We have a team that is dialed in, but we still missed the mark. We're closing on one today. I think it's a $6,000 loser. Now, granted, we've closed on some that are nowhere near that, and we've had some really great deals. But it got out of hand. It had 3 bad contracts fall through of no fault of ours. So they were all financing issues. We're on contract 4. It's been a year of holding it, and that they had this special lender that we'd never even heard of. This special program, which it's hard for us not to know a program. And they came in and they needed a new panel. There's not the panel was bad. It just didn't meet the special financing, specifications. Weird. So it had like an $8,000. We were like, okay, we're going to let them walk. But we're on our 4th contract, and you just finally say, okay. And it was already a marginal skinny deal. So then it turned into a loss. So my point is, you can be as dialed in as you want, but on those full remodels, those are not for everyone by no means. And I don't think there's enough appreciation from the market for them. They just go, oh, these guys are lipstick and a pig. And it's like, no, we go through these things and such. Granted, things will break when a buyer moves in. It's inevitable.
Yeah, I always say, just count on up to $15,000 after you move in of nobody's fault. Like, this is just how houses work. You need a roof, furnace is going to break. You're going to get a weird flood that never occurred. Sure, some people lie about it, but the houses are not brand new. And even the brand new one stuff breaks.
Yeah, so we have a ground up construction division too, and we do warranties every Monday. It's just part of it. You didn't have something that was beta tested for 5 years in a factory before they, this isn't an iPhone. Hell, those break too. So but yeah, there's just such that lipstick on a pig has become such a big term because it does happen out there. But even us, like if we open a wall, there's a bad wire or a bad plumbing line, we're going to fix it. We're going to do it right, regardless of the cost. Yeah. But even then, it doesn't change the fact. So it is definitely not a business for everyone. Our vice president of operations, he's came from the corporate world, but he's newer to this exact industry. And I mentioned the ups and downs one day, and then now we were talking the other day, and he goes, I see the ups and downs. Like, it's the good month, the bad month, the problem child. Like, I was like, yeah, that doesn't ever go away. There's not I'm smooth selling 200 transactions a year with
Yeah,
just
no.
fine-tuned process. That doesn't happen.
Yeah, and I think the market conditions always adjust what you're doing. And from what
Oh, yeah.
you were saying about lipstick flips, and we were saying, I really think that the bad flippers make it much harder for the good flippers, because now
Mm-hmm.
the consumer is like, well, there's got to be something wrong. Like, flippers are all out to make the most money, and you're like, no, we have a construction company, like, we know what we're doing. These are full gut jobs, as opposed to the one where the floors are old, the doorknobs are still old, and you're like, well, I think they should be leery of.
Yeah, absolutely. I mean, but like you just mentioned, like the doorknob, the little things, like the appreciation for it is so low, because you go in and buy, if you're doing it yourself. The thing is, you're going to go, okay, what's the comps? This broker's price opinion is still going to tell you that their house, that this person that's lived there 15 years and has done a few updates here or there, they're going to say theirs is worth the same thing that we're putting ours on the market for.
Yeah.
But no, they didn't go through and change every single piece. And people think, oh, okay, you put a few doorknobs, you did a little bit of hardware. No, that's thousands and thousands of dollars on every single job. So there's a few that appreciate it, but the custom home world or the new construction world is the same way. Some people appreciate it, but we used to be really big, and we were doing multi-million-dollar houses prior to COVID, and then we got to where we're just doing our floor plans in our neighborhoods now, because again, like the headache that it was there. Yeah, there's a little bit more money in it, but there's just zero appreciation for it. And
Yeah.
I guess you get to that point where where am I trading my time for money, and what is worth it? So.
Yeah, I mean, if you can compare them both, do you prefer ground up build, just because then it's all your stuff instead of pulling out all the stuff that somebody else did, or are the margins still better on the flip?
No, I mean, your margin should be better on a ground up, in my opinion. But the thing about a ground up, and we've said it forever, like you have a floor plan, you have some instructions. Yeah, there's some variables there, but if you built that same house before and you got a good team, they shouldn't screw that up. We've got it down. I mean, so we can do. I can build you 2,100 square foot ground up in sub 90 days, start to finish, which is
awesome.
not great for all markets. For our market, it's phenomenal. We brought that down from about 8 months, just improving processes. Heck, that same house with the right construction, it may take me longer than that if I have hiccups. But they're two very different things. One thing when you're cycling markets is it's a lot harder. Like we have specs that have been sitting on the ground. Rates have dropped. Market picked back up. Now they're all selling, but they sat there for a year and there was nothing we could do about it. I can't lower, if and I guess if you're doing enough transactions from the fix and flip, we had those as well. We lowered the prices. We took the cuts, maybe took a hit. And then we brought in new inventory the next day at a lower cost.
Yeah.
You can't do that with a new construction.
Yeah,
when the market shifts
point.
and you get stuck, you're stuck. So that's why a lot of the guys, we're like a Swiss Army knife. But if your only tool in the tool belt was ground up construction, when that market halted 12 months ago, I'm sure there's some doors with closed signs on them.
Yeah.
No doubt.
Yeah, I mean, especially if you're building multiple similar properties, you don't want to give up on the first one because you just killed your comps for the next one. The whole point is you're supposed to be scaling up, not starting like super low.
Yeah, I mean, that's what we did. We had to drop some prices, and then now it started to rebound a little bit with rates coming down. And we're getting ready to put some more specs on the ground. And they pulled up the old cost sheet, and our pro forma, and it had X dollars per foot. Well, the first thing we go is, but what did we just sell those at?
Yeah,
I get we sold a bunch for this 2 years ago, but what did we sell out in the past 6 months? Because now we just changed the market in that subdivision because we're the only builder in there. So yeah, it's two different worlds. The thing is, on the fix and flip, there's 5,000 companies out there that'll loan you 100% of cost, 90% of proceeds, blah, 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 blah. Everybody can go and do it if you got a little bit of a balance sheet money. That's not the same thing on a ground up. Like if you want to do it at scale, like at one point we had 40, 50 houses on the ground, that's a lot of lines of credit and it's not easy to grab.
Yeah, I also feel like, like I'll be reading some forums and then I'll see someone who's brand new, never done anything. And they're like, I'm thinking about doing a ground up. And I'm just like, it's absolute insanity for someone brand new first to think they can do a flip, but at least, you could get through it. It'll be terrible. You'll probably lose money. But to consider just doing a ground up, just talking to the city, you're never even going to get through, like just on your own as a new person. It's impossible.
Well, I'll see new construction guys that are like, oh, we see you're doing flips. So they start doing flips. And then you see they don't do a whole bunch of them. And then you see them go, oh, well, then they turn those into rentals. And normally they turn them into rentals because they made them look like the Taj Mahal, and it's a 1,500 square foot 1960s build. It did not need, a $30,000 kitchen. Or then they go and they're like, oh, I'm going to build up some apartments, or I want to start buying apartments. It's like you're chasing what everyone else is doing. And I guess I'm a hypocrite in the sense that we have all those divisions. That organically happened over a lot of years, and we have each division for a different purpose. But some of these guys just jump into it because they're like, well, if he's doing it, it must work. Well, yeah, but if you're doing this and it's working for you, just keep doing that too. So they're all very different.
Yeah. I mean, I think like everybody seems to stay in a lane, but as you said, you get really good at something, you can expand, but you're expanding based on existing processes that you adjust for kind of a different type of asset class. And then you can slowly figure out how to make it work. Going from flipping houses to self-storage, those they're not related. You can't just slip over the processes and think, hey, this is just going to work fine.
To that point, we bought, because we're over 1,000 doors. We're a $150 million asset company. And we brought in, it was a smaller self-storage, but we brought in $2 million self-storage facility. It was just great location, phenomenal facility. Yeah. And we bought it, came to market and we bought it. And, we raised some capital for it, raised it in a week, got this thing to closing. And then, we've had a lot of pain. We're doing well with it now.
Yeah.
But man, it took, and it's done well since day one because it was established. But what the amount of, if I had to put a dollar amount to the internal resources of us learning that field, I don't know how profitable you would say that is. Right. It's good for the investors right now, but our internal, it was, and we learned it. I don't plan on buying any more of them just because we learned really quick. It's not in our wheelhouse. So you have to be full blown ready to get into that wheelhouse. But you're right. People will go, I want to buy a mobile home park. I want to buy an RV park. No,
I just read something, I think it was this morning, and it was like, I want to get into real estate investing. I'm interested in either multifamily, short-term rentals, or RV parks. And I said, well, pass on all of them, but can we just say like, put RV parks at something you should never even talk about? You don't know anything. How can you even think you could afford it and operationally understand an RV park? And somebody else had posted below, I think you're watching too many TikTok videos. And that's part of it, though. Don't you get people who are hopped up on their social media caffeine just thinking that they can do stuff? They don't realize that, you've been doing this 18 years just to get it, not perfect. It's not possible to be perfect.
Yeah, or even close to it. Yeah, absolutely. I like that social media caffeine. It's we're active. Like we've gotten to where, I've brought in team members to where we're out there more on our social pages and just to create that reach. But, it's hard to do just because I have such mixed feelings about it. Like I want to share good content and be in front of people and talk to people, but just the amount of ads that pop up, I won't even open social hardly because it's somebody selling some class. And there's people out there that, which is I'm all about teaching and I go to seminars and sign up for stuff all the time, but you need to make sure you're giving people the real answers and preparing them for it, because if not, they're just I can't tell you how many times we've bought out a mid flip or apartment complex or something that someone, they messed up, and it maybe by no fault of their own, in reality, because they were guided by one of these courses that set them up for failure.
I love how they present those. They're like, we're selling it mid-flip. The owner just decided to go in another direction. Okay, that's why you just have it all gutted and it's just sitting there. We just want to tee it up for somebody.
Yeah,
sure.
Ran out of money is what you're reading between the lines there.
Yeah, right. In a week, because they thought it was a 20,000 rehab because somebody told them in class, oh, it's no problem, and they spent 20 on demo because they had bad, contractors who told them demo was 10x what it was.
Retail is this, remodel is this. Or you can sell it for 200, needs 50, and we're going to sell it to you for 100. You're going to make 50. It's like, whoa! I think you failed to mention the amount of holding costs and closing fees that are not listed there.
And the ARV is wrong. The ARV is really like 162, so there is no margin. Yeah. But I mean that's part of it, and I think maybe that's part of the reason you stayed away from being wholesaler, because wholesaler kind of would tarnish what you do, as a builder and a flipper, because there are some okay wholesalers in the world. There's some who really are running a business, but I've always found the best wholesalers are just usually home buyers who have overage and they're good at marketing and they don't really want to do wholesaling. They'll either get somebody else to sell them because it's a murky business. And when you have a lot of, assets coming in, you do want to dispose of them, but I think it can mess up the other stuff that you're doing. Do you agree with that?
I 100% agree with that. And I mean, I say we don't wholesale. Like we will, like if we bought something, like say there's a month where, man, our construction team's queued up to handle 10 remodels and we had a good month, to your point, marketing was great and we brought in 18.
Yeah.
Okay, maybe we squeeze 2 more in, but what about the other 6? So we go put them out there. But then what happens, people are like, well, why aren't you doing it?
Yeah.
And we're like, because we don't have that many. I don't want to expand my construction team by 60% for one overage month. I'd rather just take a skinny deal or pass let someone else, handle it.
Yeah. So, then they say, oh, well, you're just giving us the worst ones. You're like, no, we started 7. So we picked 3 of these. Like, these are good scraps. If you want the scraps, take them. But that's what I mean. I think that the people who have overage are really who end up being the best wholesalers because they were deals that they bought for themselves or acquired, and then they're just like, oh, as you were saying, no, we just have too many in the pipeline right now. So this one we're going to pass on. And maybe it is the worst of that lot, but you wouldn't have bought a bad one. You're not the wholesaler who's, acquiring everything over what they can even get a spread for.
Yeah, absolutely. And, a lot of times, or we'll do a few things to it and put it out there to where someone could move into it, but it still needs a little elbow grease. But it allows for that someone to qualify for an FHA loan. I can move into it, but now I can put sweat equity into it. And if I do it right in 3 years, I got 30 to 50,000 in equity. So, because we love seeing that, but a lot of times we'll take on the worst ones because we just know that there's not a lot of folks that'll take on those that bad.
Yeah.
So we take on the worst project because we know we can hit the ground running.
Hey, it's Jonathan. I hope you're enjoying this episode with Brian Ferguson, all about operational intelligence. We've probably talked about it in the beginning, and I know we talk about it in the back end as well. It's the overriding theme, but there's a ton of nuggets to pull from this episode. So before we get back to the show, I just want to remind you that the best thing that you can do to help the show grow is not necessarily to review it, although I would appreciate that. It's really to share it with your friends. Because if you're going to real estate meetups and meeting people and you listen to this podcast and it helps you and you can talk about all the guests that we've had on the show, which of course you can check out on the website at zenandtheartofrealestateinvesting.com, that's a great way to pass it on to others who can enjoy it as much as you do. Thanks as always for listening. Let's get back to Brian. How important are the systems overall for you? It seems like, as you were saying before, you really have it dialed in. But I mean, that's the mark of a true business. And I think a lot of people starting are thinking money, not I got to build a business that has systems and processes so eventually it can really run like a machine.
I think it's the most important thing. So we're really big right now. We started running on EOS. Well, we started an EOS style product about 2 years ago, and then we went full EOS about a year ago. But, and I said this before, I don't know if I said it in a book or podcast, but the money should never deter anyone. Like the money's out there. But nowadays, if the capital is the only thing standing in your way, you're just not trying hard enough, because you can go get all the capital in the world. I watch guys that raise money all the time and probably should not be.
But, there's a lot of those.
But getting the EOS method, like we run on, having a true dialed in accountability chart and putting the right people in the right seats that want to do things. When you establish that is what fuels the true growth. The money is such a minute piece of it. But I'm with you. Everybody thinks, oh, it must be nice. I can't do that. I didn't come for money at all. I mean, we bootstrapped everything we've ever done.
Yeah.
But if you put your arm around and bring in good people, then just keep adding the money as needed. That's where you see people that, they're sitting on the very top of the list.
Yeah. Well, you talked about EOS, just for the listeners. EOS is the operating system from Traction by Gino Wickman. And I just implementing it is actually a very large undertaking, right? So I think that a lot of people will read the book and then be like, great, that was great. But the implementation of it is very, very important. That's why there's EOS coaches out there to make sure that you keep it going, because you can't just kind of half-ass EOS.
No,
it won't work.
Not at all. Yeah, you have to be extremely intentional, but by going through that, we let team members go that didn't fit in our culture and they
Yeah.
didn't meet our core values. It made us tighten up when the right people in the right seats. You had people that you just didn't need anymore. Plus, with the market shift, so we ended up slimming down on some of our team because of that for efficiencies. And again, some people, I remember I'd said at the beginning of the year, I tell them I announced the core values. I said, "This is the way we're going. You've heard it. We're full fledged, and you can be the best salesperson, the best property manager, the best whatever in the business. But if you don't meet those core values, you're going to have to do that best work for a different organization because it won't be ours. I'd rather have someone that fits in right." But yeah, getting that piece of it in place is, and people seldomly, they want to take all the money and go, okay, I want to invest this into the next deal, buy the next product, but you don't invest in your people. And to me, all you're doing is, if you don't have the right processes and everything in place, you're hurting them on their growth. So from people processes to, we have processes and we type up, how to input a lead, how to do a make ready, we have it all documented, and then we let everyone roll it out through the proper accountability, and then manage the process. LMA is, like they say, lead the people, manage the process, and hold them accountable. So yeah, I think it's huge. It's that's what the big guys are doing right.
Yeah.
People and processes.
Yeah, and great point. Right people, right seats. I think a lot of people who aren't growing, who have a really good business, but they're not growing the way that they think they should, they're looking outside at outside factors when that's usually sitting right in front of them. There's somebody in the wrong seat or obstructing the seat, not doing what the job is. Because when you start and then you grow, sometimes people take on multiple seats from the start and they end up in a spot that they really shouldn't be in. Is that what you saw when you had to let some people go who just maybe didn't fit the way that you guys were going?
Yeah, we had to, shift who was in certain rooms, who was here. And then, a lot of times what we realized, like, you would have these people that either weren't good at something. That was one. But then the flip side of that is you have these people that are phenomenal at something. And then you wanted to just keep pushing, and you promoted them. And then you go, okay, well, since I promoted them and they're really good at this, they should also be part of these 550 other things.
Yeah.
And what it made us sit back and realize is, and then we started, we started bringing, predictive index as a big piece of our organization and how we make decisions now. But when we looked at it and thought, wow, and then all of a sudden you're like, well, I just promoted them. They were doing great. And it's like the second I gave them this promotion, 6 months later, they're doing terrible. No, they're not doing terrible. You set them up for failure. You promoted them and wanted them to start doing things they are not good at.
Yeah.
And that's why you saw loss of production and they're not going in the right direction. And then it just kills the morale. So we put people to do things that they're good at. Over the years I can go out there and do everything inside the company for the most part. I don't know how far I'd get changing out an HVAC unit or something the technicians do.
Yeah.
Those guys are the salt of the earth, especially like the lawn crew. I couldn't keep up there, but for the most part, I can do everything. And I did for years, but I'm not the best at it. And I now really focus on, and if I'm in an interview hiring a higher level position, if I don't think this person's better than me or can be better than me, then they're not the right fit for our team. Because I want to be on the dumber side of people in the room now, not the alternative.
Yeah. I mean, have you found that in your growth, like you were saying, connecting in masterminds and with other people across, that like you're looking for the rooms where everybody knows more than you? And I think there's just a subset who they want to get in those rooms, but they also want to kind of be in control. But you're not going to get to the next level unless you see what all the people who are above you are doing. Have you seen that over your 18 years?
Absolutely. And it's okay to be in both places. Like there's many times they'll ask me to get involved and do some training or coach on something. And I'm happy to do it. But then there's times where I walk in a room and I know people are more experienced. And we still have a younger leadership team. So a lot of them are still getting there and we're working on it. But like tonight, for instance, I'm doing it like an investor mixer today at like 4:30. And, I invited, they're like, so what do we want? Are we trying to get like passive investors that want to invest in our deals? I'm like, no, there's a time and place for that. That's not what I'm looking for. I don't care if it's a guy that works at AT&T and wants to learn how to flip a house. I'm going to this place. I don't mean saying I'm going to be the smartest guy in the room, but I know I'm probably going to be one of the most experienced, if not the most experienced guy out of our 20, 30 people. But that is my intention. I want to host this monthly I'm there, like, ask me anything, because like, hey, I'm all for it. Everybody, we've gotten to a point, used to, it was like, don't let anybody know your secrets because then they can be better. Like if you develop the right people, the right processes, you build the right culture where people don't want to leave, you don't have to worry about anybody, Rob. There's enough for everyone out there. Just be really good at what you do. And it's okay to share those little nuggets of knowledge. So I think there's times where you can be the most experienced or smartest per se in the room, but I want that to be less often than, not.
Yeah. I mean, I think we learn more as we teach too, but yeah, I mean, we have monthly meetups. We had them last night, and I'm the same. I just stand there. I'm trying to connect people, make sure that they know anything. We've got no speeches, no pitches. It's just like, enjoy yourself. It could be someone brand new, it could be somebody 10, 15 units. But I think that's the way to grow. Yeah, you spread yourself out between different rooms so you're diversified that way, just like you are in, real estate assets. You're just going to be able to get better. It always feels good to help someone. Or, when you're talking to new investors, I've always seen like you can kind of see the light bulb go off when they finally get it because they've been online or looking online, and then they get in person and you tell them one thing, like one person to one person, and like, oh shit, that makes sense. Like TikTok didn't tell me that because it's all, a little bit fake.
Yeah, I mean, like I have people all the time, that'll reach out, especially when I started the capital raising piece of it. People they wanted to hear about it, or and I get people book calls, and then I quickly realized a lot of these people, they weren't coming in to be investors. They were just coming in to they see us buying these big projects and want to know how we did it. So I've just gotten to where I really tell everyone, like I actually set up a special Calendly that's a 1 hour in person, and I'll tell people like, look, like my day is busy. The chances of you getting me to go to lunch with you is just because I normally eat lunch at my desk. It's a good time for me to catch up on stuff. Yeah. But look, I enjoy a good cup of coffee every morning, even though I'm trying to cut back on caffeine. But, and we have fresh coffee at the office at all times. So I have no problem showing up 30 minutes early. If someone if they want to arrange their schedule to where they can get here at 7 a.m. and want to have a cup of coffee, I'm happy to sit and answer any questions someone has. I don't care if they're the greenest noob out there. Like we're always happy to help. And I think that's important.
I think if they can show up at 7, they're motivated to ask better questions, whereas somebody who just gets open access, they're just going to be like, what do I do to become a real estate investor? And that's not a question you can answer. I don't have enough info, and 30 minutes isn't going to, cure the problem there.
I think that's why my mind goes to the 7 a.m. I always, anybody can go meet for lunch, right? Like you figure out, I got kids to take to school. I got to do that. I'm not saying it's easy. I leave the house every day at 5 a.m. to go to the gym, but if you want it to happen, you can make it happen. So if they'll be here at 7, I'm happy to share a little time with that person.
Yeah. So for your company, what's your asset class for the syndications? Are you buying all multifamily other than that one self-storage, or is there other asset classes that you guys are doing for syndications?
So we're in 2. We're doing, it has to be multifamily. We don't really have a door count as long as it can support on-site staff. So multifamily that can support on-site staff. And then we do neighborhood style retail centers. So that 10 to 50,000 square foot surrounded by a bunch of rooftops, normally have a good anchor in there, and then a bunch of 1,500, 2,000 square foot hair salons, places, cash and goes, stuff like that. So we're pretty heavy in both. I'd say we're overall portfolio is heavier in multifamily because of our non-syndicated, years of growth there. But for dollar value of what we syndicate, it's about down the middle, if not heavier in retails at sometimes.
Yeah. Are you doing any builds on the retails, or those are all acquisitions?
So they're all acquisitions. There isn't a development piece of it. So we've kind of gotten a little niche to where we'll buy single-use buildings. Like we bought an old 30,000 square foot Mr. Gaddy's and converted it into a 9-suite unit with an anchor in the back. We bought an old Blockbuster building with the highest traffic count in town and converted that into a multi-unit.
Oh, man, so that just makes me feel bad. I miss Blockbuster.
I know, it's funny. I won't spend a lot of time on it, but when I looked it up when we put this building under contract, there's still one Blockbuster left in the United States.
Yeah.
And it's like a museum.
Wait, is it in like Bend, Oregon or something?
I think you're right. I think it's in Oregon. So my crazy visionary mind went for a minute. I'm like, well, what if we made it the second Blockbuster in the United States?
I know that's what I was thinking. I'm like, can we just at least leave the sign up just to keep it there?
My whole team, I think anytime when I mentioned that, I'm pretty sure everybody in the room looked at me like, oh no, please no.
Yeah. I mean, it sounds like a good idea to me. So I'm on board on that one though, for sure. Yeah, that's interesting though. I mean, at what point did you diversify? I just assuming that you started with multifamily and then got into the retail, or was it the other way?
So prior to syndication, yes, we had duplex, we had single family, we 1031 those up when the market got really, we had a bunch of single family, we kind of got that we couldn't sell in the 07, 08 range, during that downfall.
Yeah.
And we kept those, and then those turned into amazing deals in 2018. We 1031 duplex, fourplex, and then we bought some bigger multifamily. And then early 22, I went to a conference, and I was actually going to a conference. My goal, I booked the wrong conference. My intentions were to find out how to be better operationally on the multifamily front, and ended up being a syndication. It was the multifamily. It said multifamily in the title, and it ended up being a syndication. And I came back, and I had just done a refi with my guys over at Marcus and Millchap, and they had someone in their office that had this really prime retail center. And we had a little commercial at the time, but nothing like this. And it just all happened. And so I reached out to some guys that I had been talking to about possibly investing, and we put the deal together, and then the rest is kind of history. And then I just kept growing that piece of it, adding team members and whatnot. So actually the first one was retail. Second one was multifamily, then it went retail, then it went multifamily. So it's kind of bounced back and forth.
What's been the kind of effects of COVID on your retail assets over time? Because I know for some, corner properties or, things like Macy's and things that used to be anchors, they don't really turn out to be anchors anymore. How has that held up for you guys?
Well, so we became heavy in like the bigger multifamily, like national tenant stuff. That, again, our first acquisition was 22. So I don't think I can answer that as well.
Yeah.
But through COVID, we were the proud owners of probably 50% of the bars in our town. Probably not quite that high. I think we owned 4 bars when COVID hit, 4 locations that had bars in them. And some made it, some didn't.
Yeah.
But COVID was tough for anybody in that world. So but it was definitely, I can't say that, I had the same assets we had now and how that would be affected by COVID. I'm sure that'd be a little different landscape there. But we did have some, and we worked with them. Some of them took years on payment plans to pay back. But we definitely took the approach that if you're willing to work with us, no one else is going to come lease this space. So even if it takes me 2 years to recoup the money and I have to get there, we forgave some, just did the best we could.
But did it change your acquisition strategy or the way that you're looking at how you're doing your due diligence on retail? Just that the fact that this could happen, that you could have a country shut down, because retail is obviously restaurants, they just got, destroyed. So that people don't think about the people who own the entire business and that they're losing the rent when they can't pay. But that's a big trickle down effect. Like hopefully we don't have another situation like that. But it must change something in the pipeline of how you deal with large scale retail.
Absolutely. Well, I mean, I think we all know what it did to the office, and we don't have much of that, nor are we looking at it now. But, we definitely, when we put our deals together, we make sure there's significant amount in reserves, and we underwrite to a little bit a little bit more conservative, I guess I'd say, occupancy and some of those metrics. But, you obviously can't underwrite to full COVID metrics because you'd never buy anything. But it definitely made us realize that COVID made us realize we've always been big on just, having those reserves or dry powder, so to speak, but more so going through that because it was for the first time you really had to use them. We were already kind of prepped for it because of 2017, we got hit pretty bad by a hurricane, and that opened our eyes.
Yeah.
And so those hurricane reserves end up being COVID reserves.
And where are the majority of your assets? Are they all in one state or are you spread out?
No, so everything we have we're out of Victoria, Texas. So we're a little 2 hours from Houston, kind of Houston, Austin, San Antonio, triangulated there. But all of our assets are Victoria. We just this year opened up to other markets. So we're a high 60,000 city, about mid 90s population, about 120, 130,000 MSA. And so we're now expanding into markets similar than that are within a, couple 100-mile radius of our home office. So.
Yeah, but you waited a long time to do that. It must give you a lot of buying power in the area that everybody knows you. You have different properties, like they know who to come to. So you don't really have to scratch around for deals, on Crexy or something.
Yeah, I mean, I'll say like the single families, there's just more and more people that do it. So on the flip stuff, a lot, some of the, your agents that have been around a while, bring them to us. Some of them maybe have their own newer investors that they take those to. But if it's a sizable deal, like if someone's going to list a $10 million or $20 million shopping center apartment complex, most time that's listed by an out-of-town broker. It's listed at one of the, your big national groups, but somehow, some way, even if we don't have a relationship with them, my phone rings.
Yeah.
I'd say 9 times out of 10, it's coming to us.
Yeah. Makes sense. Awesome, man. Well, if people want to talk to you or get in touch with you about the investments at Altunas Capital, is the best place for them to go altunascapital.com?
Absolutely. And there's a link at altunascapital.com. They can go click, book a call, and we can hop on a call and visit a little bit.
Yeah. Awesome, man. Well, I really appreciate your time. Is there any other places that are a good place to get in touch with you? You said you're not a big fan of social.
Yeah, I mean, I'm on there. If I get a message, I'll respond at some point. But I follow. I say that LinkedIn. You message me on my LinkedIn.
Yeah,
I'm on there. B Ferguson. But I'll message. I'll do that a lot. But the website's the easiest place. It gets a call, books directly with my cell phone, or a video chat, and that's normally the best way to get connected.
Yeah, great, man. Well, thanks so much for spending the time with us. I really appreciate it. I look forward to staying in touch.
Yeah, man. Same here. It was fun. Thank you.
All right. That was Brian Ferguson, the founder of Altunas Capital. I'm Jonathan Green. We'll see you next episode. Thanks for listening to another episode of Zen and the Art of Real Estate Investing. And I know you know by now that these are previews at the end of the episode. So if you stick around through the whole episode, listen up to 100%, get to this part, know that you only have a minute left. I'm going to let you know who's coming on next episode so you can prep for that. And next episode is Adam Zock of HomeEquityPartner.com. This is a very unique show. It's really a lot about rent-to-own homes, buying, selling, and wholesaling them, how to do it, the dynamics around it, and why Adam got into it and created Home Equity Partner. So stay tuned for that next episode, and thanks as always for listening to this podcast.